chapter, Conceptual Framework for Financial Reporting, is a concept, right? So it means that you have to understand what is actually framework ni macam is a frame, right? Means that what is the scope, right? You have to understand what's supposed to be in a financial reporting. All right, so later, remember last time we mentioned about the financial statement. All right, you have 4 types of financial statements. So all these are the concept, the conceptual framework that you should know, right? And then I think that most of you already know it. It's just that we don't actually go on the theoretical part of this, yeah, in detail. So that's why this chapter 2 meant for that. All right, the conceptual framework for financial reporting. So at the end of the chapter, you should be able to explain what is the conceptual framework, right? And we call it conceptual framework as CF, yeah, conceptual framework for financial reporting. So you should be able to tell me what it is. Hui, manalah I nak cari apa ni? I nak kena letak dekat sebelah ni. Tak boleh lah pula. Kenapa ada 2 pula? Okay. Right. So anyone coming in? Alright. So we have 38. Okay, never mind. Alright, and then what is the objective of financial reporting? And what do you mean by going concern concept? And then what? Yes?
Do you present the slide?
Oh my God, thank you. Okay, now can you see that? Yes?
Yes.
Alright.
Yes, madam.
Sorry, yeah, aku tak perasan lagi. Alright, so and then what you should be able to understand is that what are the qualitative? We have 2 types, right? We have the quantitative and we also have the qualitative. So the one that we are looking at in conceptual framework is the qualitative characteristic of a useful information. You can have a lot of information, but which one is the useful one? And then in order for an information to be useful, all right, what are the characteristics? And in this case, characteristics they are looking at are the qualitative characteristics, you see? So because when you talk about financial statement, normally you only look at the numbers, right? But we are looking at the qualitative, not the numbers, but the quality of the information. And and that information should be a useful information. All right, and then finally we look into the concept of capital maintenance. So these are the things that you're going to look into in chapter 2. Right? Oh, ada lagi. List the general purpose of financial statements. So remember that we have the 4 or 5 types of financial statements. What are those financial statements? One is your statement of financial position, right? Where your asset, liability, and your earnest equity. Number 2 is statement of your comprehensive income. Or SOPL dipanggil kan? Statement of profit and loss, is it?
Yes.
Shows you the revenue and expenses, and then from there you decide how much is your profit. And then you have statement of your cash flow. You see, it shows you your cash in and cash out, inflows and outflows of your cash. And then you also have the statement of changes in equity. So you have 4 types of statements. So you want to see that what are the purpose? In this case, what are the general purpose? What are the purpose yang dua? One is the general purpose, the other one is the specific purpose. So in the financial, in the conceptual framework, we are looking at the general purpose of the financial statement. All right, and then you identify who are the users, who are the primary users of the financial report. And then we identify and differentiate between the elements of financial statement and explain recognition and different measurement used in the financial statement. Yeah. So let's look into the history. All right. Why do we have a conceptual framework in the first place? All right. In early 19s, nak masuk. Okay. In the early 19th or 20th century, there's no accounting standards. All right. You remember that when accounting, you talk about recording all these things, it has been from the very beginning. All right. People do actually do accounting, but it's just that there's no standard of doing the accounts. Yeah, so one area could be doing in this way, the other would be doing. So there's no standards in doing accounting. So what they come out is that they come up with some best practices. They identify what are the best practices in the accounting methods, and they try to put it as formalized into accounting standards. Yeah. All right. Before that, remember in the first chapter, we went through the evolution of accounting. Remember that? The evolution of from IASC, all right, Accounting Standard Committee, become board, then you have the MASB, MIA, independence, all that, all right. There are some students, all right, just a very small number of students that say that it's very difficult to remember all that. No, I do not expect you to remember those, yeah. History is something that you will learn in order for you to understand the evolution. Just like this one, all right? I tell you, okay, history, 20th century, we don't have any accounting standard. It doesn't mean, oh, you must remember, okay, accounting standard, 20th century, tak ada lagi, okay. But you have to understand the evolution, because history ni, I never take history paper, all right? Because during my time, history is not a core subject. So I never take history paper for my examination, because I never like history, because it's always about years and things that happen, and I had to remember all the years. But if the history were taught in a way that is a story, all right, that shows the evolution of a thing, all right, or an event, all right, it would be more interesting, all right. So don't worry about even though history is important, all right, because you learn from the history, but for the purpose of this paper, right, you don't have to remember everything, yeah, don't worry about that. Okay, so from there, all right, when you don't have accounting standard, it's become difficult, because you cannot compare, you cannot, one people could arguing because they are using different methods, and they are when they have different methods, the interpretation is also different. So that's why they need to come to a standard. So how do they decide on the best standard? Is that come with some best practices. All right, what is the best way of doing things? And we're talking about accounting method here, and they formalize it into an accounting standards. Yeah. Then when there's a contradiction, so accounting standards, one country using, for example, yeah, country you have the standards already. Okay, all the people, all the practitioners in that country use standards, and then you have another standards from another country, for example. All right, so because they are standards, but because it's not uniform, all right, it could be uniform in that country, right? But then it's not from one country to another, for example. So there's a contradiction in accounting standards. So therefore, they come up with a guideline. All right, because we can't force everyone to follow the same rules. So that's why you come up with a guideline. So at least, all right, the main thing, you have to follow this thing. All right, so when you follow the main crux of it, all right, then only you can compare. So the small differences is acceptable. So this guideline is what we call conceptual framework. Right? It sets out the concepts that underlie the preparation and presentation of financial statement for external users. Remember financial statement for external users? Last time we have the management accounting, right, for internal users. But in this case, the financial reporting is prepared for external users. So that's why we say that it's a general purpose. All right. So report by an economic activity, all right, financial performance that can be used by a wide range of users. So it means that when you prepare the financial statement, you prepare it for general purpose. It means that many users can use the same financial statement and have the same understanding, all right, on the financial statement. Because of that, the interpretation of financial statement will also be similar. All right, so what are the purpose, general purpose? Number one, so the general purpose financial statement, a complete set of financial statement have these four statements. Remember, we talked about financial position, a SOPL, all right, statement of changes in equity, and statement of cash flow. So we have 4 types of financial statement. So who are the users? We know that we have the users are investors. Remember, those who invest in your money, the shareholders, lenders, for example, bankers, creditors. So creditors, normally when we say creditors, we are referring to the trade creditors. It means that the business or the company that give loan, not loan, they give, they supplies to you on credit, right? So they sell goods to you and you purchase on credit, means that you pay that amount later, right? So those are the creditors. And then you also have your debtors, those who purchase from you, right? So those who purchase from you, but they don't pay you cash, they pay you later. So they are the debtors. Creditors are the one that supplies to you. Lenders are the one that give loan, money to you, yeah? Employees, and you also have your customers, you have government and the public in general. All right. Okay, the lenders is always concerned, the investors, they want to know the risk and returns from the company, all right? How much dividend the company pays out, how much profit the companies are making, because that will be converted into their returns in the form of dividends. And then lenders concerned about whether the business can pay back. So how they know this? They look into the financial statements. Creditors sell on credit to the business. Will the business be able to pay on time? So that is very important. People who work for the business are concerned about their salaries and benefits being paid. So these are the creditors. And then we also have those who rely on goods and services of the business, right? So who are these? All right, the public. Yeah, that's concerned with its survival. So just now you look at the concept of going concern. So it's something to do with the survival of the company. Yeah. Okay. How do I go next? Right. Government tax and regulation. Of course, they are interested to know how much from the financial statement. They should be able to estimate how much is the tax liability and how to regulate in order to make sure that people pay tax. All right, and we also have the charity and corporate social activities, so all these things, right? So these are the purpose of the CF. What is CF? The CF is the conceptual framework, right? Why do you need a conceptual framework? Why? To assist standard setters set consistent accounting standards. All right. So once you have a guideline, then you do have those people we will call standard setters to set the accounting standards. So when you have the guideline, so the standard that we set is always consistent. All right. And then we also have the preparers of financial statements to select appropriate accounting methods. Who are the preparers? Later we see who are the preparers. So most of it is the accountant. All right, especially when there are no accounting standard, at least they have the guidelines. So what is the guideline? The conceptual framework. And then we have the auditors to decide whether financial statement comply with standards. So normally, all right, for companies, they have to submit the financial statements to the respective authority, and the financial statement must be audited by auditors. All right, so it means that once you have your financial statement, it's closed already, then auditors come in to check whether the financial statement has been prepared in compliance with the standards. And then users also, all right, the purpose is to assist users to better understand the financial statement. So that's why you have a conceptual framework. It means that the framework will tell you what should be done, how it should be done, and everything else. Yeah. So that's why you have the conceptual framework. Okay. The concept of the conceptual framework, right? So what you have in the conceptual framework, number one is the general objective of the financial reporting. So it should state what is the purpose of financial reporting. And then they'll tell you what are the qualitative characteristics of useful information. And then, of course, whenever you have some kind of guidelines, all right, you must have some kind of underlying assumption. It means that given a scenario, all right, these are the assumptions that we have taken into place. Yeah. For example, we're talking about providing a depreciation on a fixed asset. All right. So what are the assumption of the fixed asset? Generally, we say that, for example, all right, the fixed asset should have a useful life of several years. So that is the assumption that is being applied by the that is being applied by the preparers. Yeah. So what are the elements of the financial statements in terms of the recognition and the measurement? Yeah, and then the concept of capital maintenance. So these are 1, 2, 3, 4, 5 items that is actually deliberated in the conceptual framework. Right. So number one is that looking at the objective of financial reporting, the general objective. Yeah. So what is the objective of the financial reporting? To provide financial information. Right? Nothing more but to provide financial information. So that's why we say that financial reporting only provide one type of information. So for example, you're talking about the uses of the financial statement. Right? The uses, financial reporting is only one of the source of information. Because why? This provide the financial information. If you need non-financial, you have to look at other sources of information. Yeah. So this one is to provide financial information about the reporting entity that is useful for economic decision. Remember that we're talking about the usefulness. Yeah. In order for you to make a decision, you need useful information. Where does it come from? One is from the financial information. All right. Economic decision are decisions about providing resources to an entity. Yeah. So, for example, provide decision to provide capital to a business in terms of the investment, whether you want to hold shares in a company, especially for investor, all right, to provide loan to a company, this one refers to the lender. Right? Okay, what about the qualitative characteristic? So this is the second one, remember? The first one is the objective, then they look at the qualitative characteristic. So qualitative characteristic, they have two main one. One must be relevance, right? Qualitative. So it means that looking at the financial information provided in the financial statements, how do you know that that information has a qualitative characteristic? All right, means that the information provided must be relevance. Right? If information is not relevant, then it's not useful. All right? You can provide information, but if the information is not relevant means that it's useful for that time. Yeah, it's not that you're providing information, useful information. All right? If it is relevant at that time. All right? And also, when talking about relevance, then the idea of whether predictive value means that based on that information provided, can you make a prediction of what's going to happen based on the information provided? Yeah, predictive value. And then confirmatory value means that, all right, the information that is provided in the financial statement must be something which is confirmed. That's why it has to be audited first. Right? And talking about materiality, whether the information provided is something which is materially means that something which is significant, right? Something that can be used in your decision making. Right? The other qualitative characteristic is on the faithful representation. Yeah, so it means that the financial statement should, all right, represent how the company is doing. All right, in order to do that, it has to provide a complete information. All right, and then it has to be neutral. It does the information, the financial statement should not prepare to which is biased on the company, or even, for example, they prepared the financial statement in a way that, right, it makes the company looks good on paper. Right? This is very common, especially, for example, if the company is they want to apply for loan from the bank, they prepare a financial statement that which is not faithful, right? Because it shows a company which is good, which is maybe it's just what we call a dressing. Yeah, it shows the company is good, but in fact, the company is not. So that's why faithful representation is very important, and it has to be a concept to be applied by the preparers. And then, of course, the financial statement must also free from error, because if it provides wrong information, then it will consequently make the users make wrong decision, right? Because the information provided is wrong, so you might make a wrong decision, right? On top of that, we also enhance the qualitative characteristic by having comparability. Right, means that you can compare company A, company B based on the financial statement. All right, can you compare company A and company B? Which company is better? Right, which company provides a better returns, for example? Which company will sustain longer? Right, so comparable. And then it can also be verified. All right, if you want to verify the information, you can do that. So that is a good financial statement. It's a good characteristic. All right, timeliness. I think that timeliness and relevance are very important. Right, it's a timely information. All right, you do not want to provide information, but at the time of provision of when you provide the information, it's no longer useful, because why? It's too late, for example. Right, and then of course understandability. If you prepare financial statement that no one understand, all right, then it cannot be used, then it forfeit the objective. All right, so these are the qualitative characteristics. All right, we start with the fundamental qualitative characteristic is the relevance and faithful representation. Relevance, you have the predictive value, and then you have the confirmatory value and material, yeah, and faithful representation. And then this qualitative characteristic is further enhanced by the following: comparability, verifiability, timeliness, and understandability. With all these, then you come up with a useful information. Right? Qualities information should have to be useful. Apa ni? Right? Apa nak tengok ni? It is relevance, it means that it's related to the decision that users want to make. Right? Confirm previous evaluation. Material, if omitting it could cause the user to make a different decision. Yeah, so that's why information which is material must be in the financial statement. Right, the faithful representation, it means that it reflects the business financial performance. What about complete? All information must be reported in numbers and explanation. Information provided must be unbiased, right? Neutral. Do not show a more favorable view or less favorable view. What is free from error? There are no errors, omission. Okay, I think that this one I have, right? You can refer this later. Right, cost constraint. Of course, when talking about all these things, right, all these qualitative characteristics, to some companies, all right, and I think that to most companies is costly, right, to have all these characteristics, because you have to make sure that, for example, to be a timeliness, right, you have to push a lot, and then you have to work extra hours, so in order to make that information available on time, to make it more relevant. So but that is the thing that you have to give up, not to give up, I mean to give in. Yeah, cost constraint, all these things has to be taken into consideration as well. And some companies, when they are not able to meet, right, because of the cost, then that will affect the quality of the financial statement. All right, so what are the assumptions? So remember that these are underlying assumptions in financial reporting. All right, number one is what we call going concern. Yeah, we assume that the company is going concern. What do you mean by going concern? The company is expected to continue to operate in the future with no intention to liquidate or to close business. So going concern is very important because whenever you want to make a decision making with regard to the company, right, you must assume that the company is going concern. So for the financial statement must show that the company is actually going concern. But if the company is not going concern, it has to be clearly indicated in the financial statement in the form of notes to the accounts. All right. So company, for example, is highly, highly in debt. Right. Company that is not having enough cash. So all this will affect the going concern. In other words, if a company is not going concern, it means that it's going to bankrupt. It's going to close shop. Yeah. So especially when we have this COVID pandemic scenario, many companies that actually are not able to go in concern, right? Because cannot make sales. For example, we're talking about before this. Yeah. Now I went to Melawati Mall last when was that? Last Sunday, I think. Yeah. It was full. Yeah. It's good, alhamdulillah, because business are going back as usual because we have a lot of companies, all right, or businesses that went bankrupt, not bankrupt. They had to close down because they are not able to go in concern because they cannot generate any sales during the COVID, all right. Not enough sales to make or in order to cover for all the operating expenses, all right. So because of that, they may not having a profit for some time. Yeah. So and then it will also affect their cash flow. So all these company, we have many company actually that closed down because of the pandemic. Then historical cost can be used. Yeah, for this historical cost refers to the, what do you mean by historical cost? Means that the cost that has been transacted. Yeah, so that is the historical cost. So what are the elements in the financial statement? Why is it like this? Hold on, yeah. What is a financial statement here in financial position? I think, can you see that clearly? It's not, right? So I think that elements in the financial statement, when talking about statement of financial position, right? SOFP, you should have your asset, liability, and equity. So these are the three things that you'll see in a financial position. For those who do not have any background in accounting, all right, tell me clearly that you are not following. It's okay, please stop me. All right. So you know that when talk about statement of financial position, you must have these three items: asset, liability, and equity. All right. Number two is that when talking about statement of profit and loss, your SOPL, you will have your income and expenses. Okay. Next is that what is an asset? Asset is a resources controlled by the business. Okay. And then the example of your asset is your cash, your receivable. Receivable means that something that you're going to receive in the future. Receivable. So trade is anything to do with your business. Trade receivable means that because of the sales to your customer purchase on credit, so they will pay you in the future. So what you're going, when they pay means that you're going to receive, all right, receivable. And then example of asset is also your building and your machine in the business, yeah, used in the business. But your liabilities is actually your obligation to pay. All right, your obligation is a liability, is a commitment that you have to pay in the future. All right, payment result in an outflow of your future economic benefits. Example of your liabilities and your trade payable. So you pay. Payables mean that you have to pay in the future. Receivable, you're going to receive in the future. Receive what? Receive cash. So receivable is an asset, you have to pay is a liability. Similarly to your loan, because you have to pay your loan, so that is a liability. Right? And finally, all right, you have, kenapa hilang ni? Right? The asset after the liability is your net asset value. Yeah. So later I'll show this in more. I don't like to see this. All right. So example of your equity is your shares lah, and your retained earnings. Okay. What is this? Increases in economic benefit during accounting period due to increase in asset or decrease in liability. So that is your equity as well. Okay, apa benda ni? Okay, so the second one is the SOPL or your statement of profit and loss. So remember you have two types. One is income, the other one is expenses. So income is your sales of goods. Remember that we're talking about business. There are two types of business. Business that provides services and business that actually sells goods. Yeah. So if you provide services, that is also an income. But if you sell goods, that is also an income. Yeah, depending on which type of business are you. Income from other activities, all right, and which is, it could also be, for example, income from disposal of your buildings. Yeah, disposal of your asset, you may have gain from the disposal. So that one we'll look into later. So anything that give you a benefit, all right, cash, for example, anything that will add value, so that is an income. Right, expenses are cost of your sales, cost of paying your workers, your employees, cost of your electricity. So these are your operating costs, right? Other costs, for example, not due to ordinary businesses. So this is what we call losses. So for example, if you dispose of your asset and from the disposal, rather than having a gain, you have loss on your disposal. Yeah, so that will be part of your expenses as well. Or if the company, apa ni? Losses in flood, for example, company was involved in any of the natural disaster, flood or fire, all these things. So those losses is also recorded in your profit and loss statement. Apa ni? Okay. Then is the recognition. Yeah, recognition, how to record an item. An item is recognized when it's included in the SOFP or SOPL. Right, and then it says that in order for you to recognize, you have to look at the definition. What do you mean by an asset, liability, equity, income, or expenses? So these are the things that we have discussed earlier. All right, these are the concepts that you have to understand. And what are the probable flow of future economic benefit? So this refers to your cash inflow and cash outflow. And in order for you to record or to recognize, the item must be measured reliably. All right, so that's why we're talking about your asset. All right, how much is the value of the asset? So you go back to your historical cost. How much did you buy the asset? All right, and depends. Of course, you have to record that. You have to measure the value of the asset. So that's why not only you have to look at how much you purchase the asset, but how much have you owned the asset and how much have you used the asset. So because the value from year 1 to year 10, of course, is not dissimilar. All right, when you first purchase, it could cost you 10,000. But how much is the value of the asset after 10 years? Yeah, so the cost is different, the value is different. Value, you have to look into the existing value. You have to consider the depreciation as well. Over the 10 years period, how much is the depreciation of the asset? All right, how much the value has decreases because of the usage. Right? How to recognize a building? Does the building meet the definition of an asset? All right, so the asset, anything that is a resourceful that give benefit to the company. Right? If yes, is the inflow of future economic benefit is associated with the building, probable. Yeah, probability of you generate inflow economic benefit. Can the building be measured reliably? All right, so it means that do you have the value of the building? If yes, then you can recognize the building as an asset. So, but however, if the value of the building cannot be determined, you cannot recognize that as your asset in your business, in your financial statement. Because why? There's no value that is measurable reliably, right? Okay. How to measure? All right, you're talking about measure of your asset, liability, revenue, and expenses. We use the monetary value, right? Historical cost is the amount of the date of transaction. This is the past. Current cost is the value now. Yeah. Realizable value is the amount of value that you can, in order for you, for realizable value means that if I were to sell the asset, how much can I sell it for? How much people is willing to buy the asset? So that is your realizable value. All right. For example, if I purchase a car, when I first purchased the car, now it's 2021, I first purchased the car in 2018, for example. Let's say that the cost of the car is 100,000 in 2018. Now 2021, we have 2018, 19, 20, 21. 3 years from 100,000 could be that the value now is only 70,000. People will not pay you, all right, the car for 100,000. Because over 3 years period, the value has depreciated. So now the value of the car could only be 70,000. So people will only willing to pay 70,000 for the same car. All right, because it's not a new car, it's a used car. So the value has reduced. So that 70,000 is what we call realizable value. Right? And then we also have value, what we call present value. Right? So if you do finance later, right, you see that you will have this present value, your future value. So all this value is computed based on a certain assumption. All right, what is the interest rate for the item, for how many months to go, for example. So the value for now for a payment in the future. So you have to compute what is the present value, what is the future value of an asset. So that you know that how much you have to pay in order to meet over that period of time. Okay. And finally, all right, in the conceptual framework, you do have this concept of capital maintenance. All right. So this capital maintenance, there are two types, is the financial and the physical maintenance. Financial maintenance, all right, is the shareholders has to provide capital to the business, right? If they keep it, provide capital, of course, from the very start, you have to provide, because company has to start with something. All right, so you provide capital. So the provider of the capital is what we know as shareholders or the owners of the company. Right? It's the business responsibility to protect the capital and grow it. Right? So grow means that from 1 ringgit to 10 ringgit. Right? For example, the value of the shares. When you first purchase the shares could be 1 ringgit. But after some time, you expect that the value of the company to increase or to grow. So how do you see the growth of the business? The growth of the company is sometimes you can be reflected in the share price. Right? A profit is earned only if the financial amount of the net asset at the end of the period exceed the amount at the beginning. So remember that, okay, we do have, later we see that you started with asset, liability, and honest equity. All right. And then using the whatever amount invested in the company, then you make sales, for example, you have to look at your income and your expenses, then you have your profit. So the profit that you gain is the additional to the equity. Yeah, so that will add on to the value of the company lah. Right? So later we'll also look at a profit is earned only if the operating capital means that your income is more than your expenses, right? And then you have to compare beginning of the year and end of the year, how the company has performed. Has it increased? Has the capital maintenance increased? Yeah. Hai, habis. Eh. Aduh, bercakap-cakap dah habis lah. Hold on ya. So what is the time now? We finish in 3:20 kan? We have about 40 minutes to go. Okay, I stop the recording.